Understanding stock market crashes, a primer. A stock market crash is a sudden and dramatic drop in stock prices. This phenomenon can send shockwaves through the financial world, affecting not just large corporations, but also individual investors. This decline is often driven by panic selling, where investors rush to sell their holdings out of fear. The fear of losing more money can create a domino effect, leading to even more selling and further declines in stock prices. Crashes can be triggered by a variety of factors, including economic downturns, geopolitical events, and even simple shifts in investor sentiment. For instance, a sudden economic recession can erode investor confidence, while geopolitical tensions can create uncertainty and instability in the markets. They can be swift and severe, wiping out billions, even trillions of dollars in market value in a matter of days or even hours. The speed and severity of these crashes can leave investors with little time to react, exacerbating the financial damage. The recent market turmoil has left many investors feeling anxious and uncertain. The volatility can be overwhelming, especially for those who are new to investing or who have significant portions of their savings tied up in the stock market. Understanding the dynamics of a stock market crash is essential for investors of all levels of experience. Knowledge is power, and by educating themselves about the causes and effects of market crashes, investors can better navigate these turbulent times. By understanding the causes and consequences of these events, investors can make more informed decisions and potentially mitigate their losses. This includes recognizing the signs of an impending crash and knowing when to hold or sell their investments. It is important to note that stock market crashes are a natural part of the economic cycle. They have occurred throughout history and will likely continue to happen in the future. Each crash, while painful, also serves as a learning opportunity for investors and economists alike. While they can be unsettling, they also present opportunities for savvy investors to buy undervalued stocks. During a crash, stock prices can fall below their intrinsic value, creating potential bargains for those who are willing to take the risk. The key is to stay calm, stay informed, and avoid making rash decisions. Panic selling can lead to significant losses, while a well-thought-out strategy can help investors weather the storm and come out stronger on the other side. By maintaining a long-term perspective and focusing on the fundamentals, investors can navigate market crashes with greater confidence and resilience. The recent stock market volatility can be attributed in part to growing concerns about a potential economic slowdown in the United States. Investors are on edge, watching every piece of economic data and corporate earnings report with bated breath. The uncertainty is palpable and the market's reaction has been swift and severe. The U.S. economy, a powerhouse on the global stage, has shown signs of slowing down after a period of robust growth. Manufacturing output has decreased and consumer spending, a key driver of economic activity, has started to wane. This slowdown is not just a blip, but a potential signal of more challenging times ahead. Inflation remains stubbornly high, prompting the Federal Reserve to implement aggressive interest rate hikes to cool the economy. These measures are designed to reduce the money supply and curb spending, but they come with their own set of risks. Higher interest rates make borrowing more expensive, which can dampen investment and consumer spending even further.
These rate hikes, while intended to curb inflation, have also raised fears of pushing the economy into a recession. Economists are divided on the issue, with some arguing that the Fed's actions are necessary to prevent runaway inflation, while others warn that the economy is too fragile to withstand such aggressive measures. A recession in the U.S., the world's largest economy, would have significant ripple effects across the globe. International markets are already feeling the strain, with stock indices in Europe and Asia showing increased volatility. The interconnected nature of today's global economy means that no country is immune to the effects of a U.S. downturn. This interconnectedness of the global economy means that when the U.S. economy sneezes, the rest of the world is likely to catch a cold. Trade relationships, investment flows, and even currency values are all influenced by the health of the U.S. economy. A slowdown in the U.S. can lead to reduced demand for exports from other countries, affecting their economic growth as well.
The fear is that a U.S. economic slowdown could lead to a domino effect, where reduced consumer and business spending in the U.S. impacts global supply chains and trade networks. This would translate into reduced demand for goods and services from around the world. Countries that rely heavily on exports to the U.S. would be particularly hard hit, facing declining revenues and potential job losses in key industries. This decline in demand could then trigger a global recession, impacting businesses and markets across continents. The effects would be far-reaching, affecting everything from employment rates to government budgets, and could take years to fully recover from. The world watches closely, hoping for signs of stability and a return to growth. The Indian stock market, much like its global counterparts, has not been immune to the recent global turbulence. The ripple effects of a potential U.S. slowdown, coupled with domestic factors, have weighed heavily on investor sentiment.
The benchmark indices, the Sensex and the Nifty, have witnessed significant corrections, reflecting the underlying nervousness in the market. The recent market downturn has resulted in substantial erosion of investor wealth. Billions of rupees in market capitalization have been wiped out, leaving investors, both big and small, counting their losses. The IT and financial sectors, heavily reliant on foreign investments and global growth, have been particularly hard hit.
The impact of this market decline is being felt across the Indian economy. A prolonged slump in the stock market can impact consumer sentiment, leading to decreased spending and investment. This, in turn, can have a cascading effect on businesses, impacting their profitability and growth prospects. Section 4, Election Jitters, adding fuel to the fire. Adding to the uncertainty in the Indian market is the upcoming Lok Sabha election.
The outcome of this election will have significant implications for the Indian economy and investor sentiment. The uncertainty surrounding the election results has led to a wait-and-watch approach among investors, resulting in reduced market participation and volatility.
Historically, election years in India have been accompanied by heightened market volatility. The outcome of the Lok Sabha election will determine the political landscape for the next 5 years, directly impacting policy decisions and economic reforms.
This uncertainty makes investors cautious, leading to a slowdown in investment activity. The period leading up to the election is often marked by speculation and rumors, further contributing to market volatility. While some investors may see this period as an opportunity to capitalize on short-term market movements, others prefer to stay on the sidelines until a clearer picture emerges.
Section 5. Experts divided, navigating the fog of uncertainty. Market experts and analysts are divided in their opinions about the future trajectory of the market. This division is not just a minor disagreement but a significant split that reflects the complexity and unpredictability of the current financial landscape.
Some believe that the recent correction is a healthy adjustment and that the market will stabilize soon. They argue that such corrections are a natural part of market cycles and can help prevent bubbles from forming. They point to strong corporate earnings and a resilient Indian economy as reasons for optimism. The robust performance of key sectors such as technology and pharmaceuticals further bolsters their confidence. Additionally, the government's proactive measures to support economic growth are seen as positive indicators.
However, others are more cautious, predicting further downside risks. They highlight that the market's recent volatility could be a sign of deeper underlying issues that have yet to surface fully. They cite concerns about global economic growth, rising interest rates, and geopolitical tensions as potential headwinds. The ongoing trade disputes and political instability in various regions add layers of uncertainty that could impact global markets.
This divergence of opinions underlines the uncertainty prevailing in the market, making it challenging for investors to make informed decisions. The lack of a unified outlook means that investors must navigate through a fog of conflicting information and predictions. This lack of consensus among experts further adds to the anxiety among investors. The fear of making the wrong move can lead to hesitation and missed opportunities, or worse, hasty decisions driven by panic. The absence of a clear direction from those considered knowledgeable about the markets makes it even more difficult for investors to determine their investment strategy. In such times, the importance of thorough research and a well-thought-out plan cannot be overstated.
This period of uncertainty calls for even greater prudence and careful analysis before making any investment decisions. Investors are advised to diversify their portfolios, stay informed about global events, and consult with financial advisors to navigate these turbulent times effectively.
Instead of trying to time the market, which is a risky proposition even for seasoned investors, investors should focus on building a well-balanced portfolio that aligns with their risk appetite and financial goals. Investors should use this period to review their portfolios and ensure they are well diversified across different asset classes. The market downturn, while unsettling, also presents an opportunity to acquire quality stocks at potentially discounted valuations. Section 6. A time for prudence, long-term vision over short-term panic. In these uncertain times, it is crucial for investors to avoid panic selling and instead focus on long-term investment goals.